Hi, and welcome back to another video in this tutorial series. Before we jump into building our trading robot, I think it's important to give you some of the theory behind how the bot works. Our robot is based on the no-nonsense Forex algorithm, which has a well-defined money management system. It trades on the daily time frame, and it's a trend following system. The combination of these three things addresses three of the biggest mistakes that beginners make when starting out in Forex trading, so let me explain what they are. Mistake number one is trading too big. Here in Australia, the highest amount of leverage you can get is 500 to 1, which means with a deposit of just $1,000, you can trade up to $500,000 worth of foreign currency. Let's see what happens if we decide to take full advantage of this crazy amount of leverage in a live example. Here's a demo account with $1,000, and I'm going to buy 5 lots on the Aussie Kiwi, which is equivalent to $500,000. It won't let me execute because I need to allow some money for commissions, so let's buy 4.9 lots instead. The first thing to notice after executing this trade is your equity has dropped to around $900 just from spreads and commissions alone. So even if you close this position instantly, you're already down 10%. The second thing to notice is this stop loss section on the right here, which is a very handy calculator, and it shows that price only needs to move by 22 pips to wipe out your whole account. Let's fast forward by an hour and the price has fallen by 10 pips. We are down 50%. At this point, even though it hasn't reached our 22 pip stop loss, our broker will actually start closing our position bit by bit because we have less than 50% of the required margin. This is actually a good thing because it's meant to prevent your account from going negative, but it also means you won't get a chance to recover if the market bounces back. We don't want our robot to trade too big, so we need to give it 3 simple rules for each trade that it makes. Number 1 is to set a stop loss at 1.5 times the ATR. Number 2 is set a take profit at 1 times the ATR. And number 3 is to risk 2% on each trade. These should look pretty familiar if you've been through the No Nonsense Forex money management playlist. The full money management system has more rules, but this is what we'll be starting with. Let's go back to our demo account to show you what this looks like. I've put the ATR indicator on the chart and it's currently sitting around 52 pips. So we set our take profit at 52 pips, set the stop loss at negative 78 pips, and then we change the quantity to get to the 2% risk, which works out to be about 0.03 lots. Pretty easy, right? Now for our $1,000 account, we are risking $20 on this trade if it hits our stop loss. We will make $14 if it hits our take profit, and we paid a commission of about 50 cents, which I'm much more comfortable with if I'm going to let this bot trade for me. VP gave us these rules, but he doesn't really explain the reasoning behind them, so let me give you my take on these rules. The ATR indicator is a measure of volatility, or how noisy the market is, and noise is the biggest enemy for any trend following system. You don't want to get stopped out by normal market fluctuations, so you set your stop loss further away to give your system enough room to work. By the same token, you actually don't mind having your take profit hit by normal market fluctuations, so you're putting the odds in your favor. That explains the first 2 rules, and for the third rule of 2% risk per trade, that can be explained by a concept called risk of ruin, which is the probability of blowing up your account. As soon as you risk more than 2%, your risk of ruin goes up drastically. I won't explain it in detail here, but I will leave a link to a video which explains this concept well in the description below. One final point I want to make here is that these rules allow us to calculate the break-even win rate for our system. The formula for this is risk divided by risk plus reward, which comes out to be 60%. That means if we assume no commissions and we take these trades totally at random using the 1.5 times ATR stop loss and 1 times ATR take profit, we expect 60% of our trades to be winners. This consistent framework is super useful when it comes to backtesting, because we know that whatever indicator we're testing, as long as it gives us a win rate of more than 60% over many trades, then it could give us the edge that we're looking for. Now on to the second mistake that beginners make, which is trading too often. Most people start in Forex by looking at the lower time frames like the 5-minute chart or the 15-minute chart, because their idea of day trading for a living means staring at the screen for hours and actively trading in and out of the markets. You can make money doing that, but it's just a much harder game to play, and the simple reason for this is transaction costs. I'll show you what I mean. Let's take the same trade that we made earlier, applying the same rules on the hourly chart instead. The ATR here is 11 pips, so we set the take profit at 11 pips and we set the stop loss at negative 16 pips. Then we increase the quantity traded to 0.14 lots to get to the same 2% risk. Here you are still risking $20 to make $14 on this trade, but instead of paying 50 cents in commissions, you're now paying $2 in commissions. See how the game gets much harder? And it only gets worse the lower the time frame that you go, so you should always start on the daily time frame before exploring the lower time frames. And by the way, once we've built our robot, it's actually really easy to test it out on the lower time frames, and I'll be showing you how to do that. This is what the equity chart looks like, running the same strategy on the 1 hour time frame. Not very pretty, huh? Once we're done building our bot, I might share some of my intraday strategies as well, but for now we're just going to stick to the daily time frame. That brings me to the last mistake that beginners make, which is trying to pick tops and bottoms and going against the current trend. The much easier game to play is to go with the trend rather than against it. That's why the other 5 pieces of the no-nonsense algorithm are there to confirm that the market is trending and to make sure that you're positioned in the same direction of the trend. The last thing I want to mention is that smaller niche markets tend to trend more than larger crowded markets because they have less automatic stabilizers. Let me give you an example to explain what I mean. Imagine you're a large super fund and you have a target allocation of 60% to equities and 40% to bonds. Let's say equities is in a strong uptrend and went up 10% while bonds didn't move. Your portfolio now has 62% allocation to equities and you are forced to sell into the strong uptrend to get back to your target of 60%. This is what I mean by automatic stabilizers. And the larger and more crowded the market, the more powerful these automatic stabilizers are. The same thing applies to currency, and that's why VP suggests to avoid the major currencies like the Euro USD, and why less crowded pairs like the Aussie Kiwi or even Bitcoin work so well for trend following strategies. I hope that gives you a bit of insight on how the large institutional players work. It also highlights the fact that markets are not random, which means it is possible to find an edge to extract consistent profits from the market. You just need to know where to look. If you found this video helpful, please give it a like and remember to subscribe if you haven't already, because in the next video I'll be showing you where to get all the tools we'll be using and then we can start building.